Today, we are focused on the sale of stocks and bonds, a critical area for Part 1 of the Enrolled Agent exam. Everything begins with calculating the basis, which is typically the purchase price plus any commissions. The exam will test your knowledge of the default method for identifying shares sold, which is first in, first out, or FIFO. Imagine a client bought 100 shares of a tech company at $50 in May and another 100 shares at $80 in September. If they sell 100 shares in December for $90, FIFO dictates that the shares sold are the first ones they bought, the ones with a $50 basis. This results in a $40 per share or $4,000 short-term capital gain. An exam question might provide a scenario where the client wants to minimize their gain. Unless the client specifically identified the $80 shares to their broker at the time of the sale, they are locked into the FIFO method. Specific identification must be timely. You can't just decide which shares you sold after the fact when preparing the tax return. Basis also changes. The exam loves to test adjustments from events like stock splits. If a client owns 100 shares with a basis of $200 per share, and the company announces a 2-for-1 split, the client now owns 200 shares. Their total basis is still $20,000, but the per-share basis is now $100. A common trap is to think value was created. It was not. The original basis is simply spread over more shares. Now let's discuss a favorite exam trap, the wash sale rule. This rule prevents taxpayers from claiming a loss on a security if they buy a substantially identical security within 30 days before or after the sale date. So, if a client sells 100 shares of a stock at a $1,000 loss on October 15th, but then buys 100 shares of the same stock on November 5th, that $1,000 loss is disallowed for the current year. The exam will test what happens to that disallowed loss. It is not permanently lost. Instead, the disallowed loss is added to the basis of the new shares purchased. So, if the new shares cost $5,000, their new basis becomes $6,000. Additionally, the holding period of the original shares tacks on to the new shares. After you've netted all gains and losses, the exam requires you to know the capital loss limitation. A net capital loss can only be deducted against other income up to a maximum of $3,000 per year for taxpayers who are single or married filing jointly. A common test question will give a taxpayer a $15,000 net capital loss and ask for the current year's deduction against their wages. The answer is $3,000. The remaining $12,000 is not lost. It is carried forward to the next year. This carryover retains its character, meaning a long-term loss carries over as a long-term loss, and a short-term loss carries over as short-term. To remember these key rules, use this phrase: basis is your cost, wash it out if it's close, and lose only $3,000 at most. This connects your starting point with the 30-day wash sale window and the annual loss limitation, which are the most heavily tested concepts in this area.